Hey, good morning options traders. Well, this video is going to be a little different from what I normally do. This is more of an accounting topic, but I think it's really important for traders and investors to understand because I've heard traders say things like, how come one company might increase sales, let's say 20%, and yet the price hardly moves on the news, and another company can have the same increase in sales, 20%, and the markets go absolutely bonkers? What's happening? Why does the market respond so differently when two companies apparently have the same increase in sales? Well, there are a lot of reasons that could be happening, but one that is often overlooked is this idea of operating leverage. So what is that? Well, in the market, we have many types of risks. There's a market risk, which is simply the day-to-day fluctuations in prices. We have financial risks, we have credit risk, and there's another called operational risk. And this is the one that most people are completely unaware of. And yet it's very real. And it creates just as much leverage, or possibly in some cases even more, than if a company used financial leverage. So that's right. There are actually two types of leverage that you have to be concerned with in the markets. There's one called financial leverage. This is just the use between debt versus equity. You might know it from margin trading. If you buy shares of stock on margin, you are using some debt to finance that equity. And therefore, if the stock moves in your favor, you're going to be doing a lot better. And if it moves against you, you're going to be doing a lot worse. That's what most people think of when they hear the term leverage. But it's just one type of leverage that you have to understand. The other is operating leverage. And this has to do with the relationship between the fixed costs of a company versus its variable costs. And it turns out that the greater the fixed costs, the greater the operating leverage. So what's the difference between fixed and variable costs? Well, if you haven't had accounting, they're actually pretty simple. A fixed cost doesn't change with levels of production. No matter how much you increase your sales, your fixed costs stay the same. Variable costs, on the other hand, do change with your levels of sales or your levels of production. So within your own household, a good example of a fixed cost is your mortgage. A variable cost might be your electric bill or your utility bill. So if you close up the house and take off for vacation for a month, your electric bill might drop dramatically. Your utility bill might drop dramatically. But that mortgage doesn't budge. It stays exactly the same. And so it's this idea about how these costs are affected with levels of sales that can create leverage. So to see it work, let's create two different companies, and they're both debt-free. So again, this is why sometimes traders say, well, I only invest in companies that are debt-free, and they therefore think that they're not using any leverage, and that's not true. You might have a very high degree of operating leverage. So we're going to assume that both of these are completely debt-free, but still look at the leverage that can be generated. So the first company has, let's say, assets of 1,000. They sell 100 units at $1 a piece, and therefore their revenue is $100. Their fixed costs are $10. Variable costs are 50 cents per unit. And therefore the total variable costs, or the 100 units that they sold, times 50 cents, or $50. And therefore the total costs are the numbers in red. Total fixed cost plus the total variable gives them $60. What's the profit? Well, it's the revenue here in green minus the numbers in red is 60. So that gives them a profit of 40, or a return on assets, or an ROA of 4%. And what this means is that this company generated a profit of $40 by using assets of 1,000. It's one of many types of, we might call it an efficiency ratio. How well can this company produce a profit given its level of assets? So in this example, they've created an ROA of 4%. Now let's take a look at a second company. It also has assets of 1,000, sells 100 units at $1 a piece, and therefore has revenues of 100. So far, exactly the same as the first company. But now we go off on a serious departure. Look at the fixed costs. $50 compared to 10. Variable costs are only 10 cents though, compared to 50. So this company's variable costs are 100 times 10 cents, or 10 bucks. Total costs are therefore the numbers in red, 60. Profit is therefore the same of 40, and an ROA exactly the same of 4%. So once again, this is where traders will look at this and say, hey, I'm looking at two different companies. They're virtually identical. They both have the same level of sales, same level of assets, same ROA, and yet one seems to get much bigger responses for an increase in sales. What's going on here? Well, it has to do with the size of these fixed costs. And because these have to be paid regardless, if sales increase, you are simply dropping the average level of these fixed costs dramatically, but you're not really increasing your variable costs that much. And so it's creating a very big increase in the ROA. So for instance, let's say that sales increase 30% for both companies. What happens for company one? They still have assets of 1,000, 130 units now. That's a 30% increase times $1, revenue of 130. Fixed costs stay the same at 10 bucks. Variable costs are still the same level, 50 cents per unit, but we have 130 units times 50 cents. So look at how much larger the fixed costs are. And therefore their total costs, numbers in red, 75. Profit is therefore 55. That's just 130 minus 75 for an ROA of 5.5%. So they had an ROA of 4%, and now it's 5.5%. That is a 37.5% increase. We could also say it was an increase from the profit of 40 to 55. Same difference. It's a 37.5% increase to the bottom line. But what happens to the second company? They had assets of 1,000, 130 units sold at $1, revenue of 130. Again, exactly the same as this company. But their fixed costs didn't change. And yet their variable costs didn't really go up that much. They were 10 cents times 130 units for only 13 bucks. So now their total costs, 50 plus 13, 63, gives them a profit of 67. That's just 130 minus 63. And so the 67 profit gives them an ROA of 6.7%, or an increase of 67.5%. Look at the difference, 37.5% compared to 67.5%. This is why some companies' stock prices are met with a lot of fanfare when it appears that they had the same increase in their sales as another company. It could simply be the level of fixed costs. And this whole idea is really what's called the degree of operating leverage. And there's a number of formulas. Probably one of the easiest is to take the level of sales, the quantity, times the price per unit minus the variable costs. And you're going to divide that by the same number here minus the fixed costs. So for the first company, initially they had 100 units of sales at $1 a piece minus 50 cents of variable costs. So $1 minus 50 cents is 50 cents times 100 is 50 bucks. This number right here is exactly the same. It's also 50 bucks minus 10 is 40. So 50 divided by 40 is 1.25 times. This is the operating leverage of this company. Doesn't matter if they're debt-free. They still have leverage from the operations of their business. So a faster way to come up with the previous answer is to take the 30% increase in sales times our leverage, 1.25, gives us 37.5%. Exactly what we came up with previously. What about the second company? 100 units of sales initially times $1 minus only 10 cents of variable costs. So $1 minus 10 cents is 90 cents times 100 is 90 bucks. This number right here is the same. 90 minus 50 is 40. So 90 divided by 40 is 2.25 times. Much bigger leverage. So for a 30% increase in sales times 2.25 leverage gives them an increase of 67.5%. So once again, you have to understand that just because a company might be debt-free, depending on the level of fixed costs, you could still be dealing with a highly levered company. And the danger here is to always remember that leverage is a double-edged sword. Sure, high operational leverage increases profits with greater sales, but it also dramatically decreases them with lower sales. So think about it with the companies that you're investing in. Who has high fixed costs? Well, it might be companies in the manufacturing fields. Think of things like Tesla. Big, expensive factories that have to be paid for whether they produce one car or 1,000 cars or 10,000 cars. High levels of fixed costs. What about airlines? Airlines are loaded with fixed costs. It turns out that an airline's cost to fly from one location to another is almost identical, whether it carries one passenger or is fully loaded. Now sure, they'll face small increases in variable costs. They might have a little extra fuel that they have to burn. They might have to provide more lunches and drinks. They have to print up more tickets, but they're relatively small compared to the planes and the airport terminals and everything else that has to be paid for whether they fly or not. And this is exactly why during coronavirus that the airlines were in the spotlight so much. It was because of these high fixed costs. And that created tremendous, dramatic leverage to the downside. So yes, even though we had a lot of companies that weren't operating, or at least sharply reducing their sales, they didn't have the same leverage as the airlines. So when you're investing, it's not just a matter of finding companies, or if that's what you prefer, finding companies that just have low financial leverage. You also have to understand the degree of operating leverage. And if you do, it's going to help you to manage risks that others will overlook. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com, as well as a brand new technical analysis course for 2021. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.